Okay, welcome to Accounting 101, or I guess I should say welcome back to Accounting 101. Chapter 7, Internal Control and Cash. Before we go any further, I just want to make the announcement that Chapter 7, Internal Control and Cash, is probably one of the easier chapters in the textbook. Okay, and we got that out of the way. What is internal control? Internal control is a system whereby we safeguard assets, ensure the integrity of the financial reporting system, and as the authors state in the beginning of the chapter, there's a four characteristics, a four-part definition. Let me just back up. Safeguarding assets, encouraging employees to follow company policies, promote operational efficiencies, and ensure accurate, reliable accounting records. I always have a problem with number 3 there, promoting operational efficiency, because internal control actually is sometimes a bit of a pain in the butt, if you would forgive me my use of that kind of language. It is the little things you have to do if you work for a place where they have a operations or procedure manual, the standard operating procedures, where if you need something, you have to go through proper channels, get the proper authorizations, proper documentation, and get one or two or three people above your position to authorize an okay and sign off on it. That's internal control right there. So maybe some of you have experienced it, maybe some of you haven't. That third aspect, like I said, it actually, I don't know if I buy into that 100%. Efficiency would be, if I need something, let me call and get it from wherever I can get it at the best lowest price. But more importantly, the big things are the other three aspects, or at least the other two, of safeguarding assets and for ensuring accurate, reliable accounting records. Okay. What do we do as far as, this case, this chapter deals with internal control in general, and specifically internal control over cash. Why do we need internal controls? Well, like it says in the definition there, to safeguard. And cash is the most active account you'll have in a business, because there's cash coming in and cash going out. And it's very hard to ensure, not very hard, but it is a time-consuming job to design a good internal control system that will give you control over cash, because it moves so quickly in and out of the business. It's not like your building or your delivery trucks that you have. You buy them, and, building, you might buy a building every 5, 10, 15, 20 years. And it pretty much stays there. You pull up in the morning, you can see the building, it's still there. Well, cash is coming in and going out of the checking account, going in and coming out of the certificates of deposit or negotiable order withdrawals. You got cash in the register. You got cash all over the place. You got multiple people having access to it. So every time it changes hands, there should be some way to control it, to document how much there is and how much is being transferred from one place to another place. Every time somebody touches it, you have the potential for having theft. So it's a very valuable asset. And like I said, it's a very active account, very active asset. A lot of cash coming in, a lot of cash going out. So it needs a little bit extra attention, more so than other assets like building or vehicles, airplanes, that kind of thing. All right. Back in 2002, Congress passed the Sarbanes-Oxley Act, which is commonly known to business people and accountants, particularly as SOX, S-O-S, SOX, Sarbanes-Oxley. They're the two senators that passed the legislation, and that legislation was a reaction to the Enron fiasco, the collapse of Enron Corporation. There were some violations, some collapses prior to that, and they were associated with some accounting failures and auditing failures. So, and this is nothing new. This runs in cycles. And every time they had something, a bad go of it, the AICPA, American Institute of Certified Public Accountants, would say, we'll take care of it. We'll strengthen up our standards and auditing standards and accounting standards. And that's why we went from the Accounting Principles Board to the FASB. And this time, Enron was a camel, or the straw that broke the camel's back. And the government says, "No, we've heard from you, heard you people say that before. We're going to step in now." And it was a good thing. It's a bad thing for an accountant. It was a black eye on the profession. The Enron failure. There was a lot of blame to go. Every party had some culpability in the failure of Enron, but it starts with corporate governance, and Enron had very lack governance controlled by their board of directors. Management ran the place. Management was very low ethical standards, and they were trying to rid it for themselves. The book here talks about Enron Corporation. They also mention WorldCom. Well, if you people are online, but if you were ever on campus, there's a dorm to the northeast, I guess you'd say, of Insulaco Hall called McGowan Hall, named after Monsignor McGowan. Well, Monsignor McGowan's brother, John or Jim, founded MCI Communications, McGowan Communications, Inc., right after the ordering, or just before the ordering of the breakup of AT&T. What was that, back in the 80s? Or yeah, back in the 80s, I guess. 1980s. And the Monsignor got some shares from his brother, I guess, and he retired. I think he passed away a few years ago. But he was living up at Glenmar, past the airport. And he gave the school a lot of money. He gave King's College a lot of money. In fact, the local CPA, Charles Perrine, who founded the firm Perrine, Randolph, Orlando, and Cary, which is now Baker Tilly. He gave the school, he gave King's $1 million, thinking they'd name the business school after him. With a short period of time, McGowan, who went to King's, gave them $3 million or $10 million. So they named the School of Business after him. They did name the building after Mr. Perrine, though, if it's any consolation. God rest his soul. So that's a little history on internal control. Now, this Sarbanes-Oxley Act really shouldn't have been needed had the CPAs done what they were supposed to do. But somehow they lost track of what they were supposed to do, and they sold their soul to the devil. The Enron auditors was Arthur Andersen out of Chicago. Probably their Houston office, but their world headquarters is Chicago. And Arthur Andersen himself had a great reputation, and he probably turned it in his grave when the company he founded had to go bankrupt because of Enron. But he was instrumental in instituting continuing professional education for CPAs. He did it before it was required, and when people saw the benefit and how well it benefited his employees and his firm, the AICPA instituted it nationwide for all accounting firms, regardless of their size, for all CPAs. You have to get 80 hours of every 2 years. And it has to be divvied up between 16 hours in accounting and auditing, 8 hours in tax, 4 hours in ethics, and the rest of it can be done in anything that's related to business. And it has to be done by a certified, not a certified, but a registered provider, and they have certain things they have to meet, criteria. So it's that after 90 years, Arthur Andersen had to close down. And again, he had a motto. I use one of his, the Enron case I use in my MBA advanced auditing course. And Arthur Andersen himself told he was the first CPA problem. Well, I don't know, the first one of note to refuse clients or to tell clients you have to change this or change that, or I'm not giving you a clean audit opinion, unqualified opinion. He had a motto for the firm he founded. He said, think straight, talk straight. And that was it, you know. And that pretty much is what, should be a model for all of us. Now, the Sarbanes-Oxley Act only pertains to public companies or a public company. A public company is any company that sells its securities, either its bonds or its stock, to the public on an open exchange. Okay. The big thing that came out of the Sarbanes-Oxley Act is the PCAOB, which is the acronym for Public Company Accounting Oversight Board. Congress actually has the power of setting the accounting rules, or the SEC does, but they have acquiesced that to the Financial Accounting Standards Board, but they do have input on it, and sometimes if they don't like something the FASB is proposing, they'll weigh in on it. In fact, the FASB has a whole set way of instituting a new standard, and one of the steps in it is to have an exposure draft that is open to the public for comment. And you or I could comment on it, but more likely a lot of big accounting and auditing firms comment on it, as do a lot of the big companies that are going to be affected by it will comment on it. Okay, but the SEC will comment on it too, and so will various members of government and academia as well. Some important provisions of the Sarbanes-Oxley Act are listed there. They list 4 of them. Public companies must issue an internal control report. They should have done this. This made it required and by law. The thing I like about the Sarbanes-Oxley Act is that it, up until this time, if there was malfeasance or malpractice on the part of management, the company got fined. After Sarbanes-Oxley, the executives involved will actually are looking at jail time. WorldCom, or at the time it was MCI Communication. No, it was WorldCom. In fact, I was personally harmed by that because a broker that I was using at the time, who I no longer use, recommended me to put some money, my hard-earned money, invested into MCI, and I lost my money. And the Bernard Ebbers was the head of MCI at the time, and he was the first corporate executive to be sentenced to jail time under the Sarbanes-Oxley Act. And every time I saw him on TV being led in or out of the courtroom or into jail, I kind of jumped up and cheered. Didn't help me financially, but it did make me feel better. Unfortunately, yeah, you should. When you're investing, you shouldn't have emotions, but unfortunately, we can't turn them off 100%. I said, good for you, SOB. But the PCAOB oversees auditors of public companies, and they have to have a peer review, and they have to be registered with them in order to do audits. You not only have to have a license as a certified public accountant, you have to be registered with them, and to be registered with them, you have to go through some hoops, jump through some hoops, and do some things, and it's an expensive process. If you're doing audit of a public company, you have to be registered with the Security and Exchange Commission and the PCAOB. Security and Exchange Commission is a quasi-governmental body. The accounting firms are not allowed to audit a public company and also provide certain services. They say consulting services. Well, you can't do tax work. I forget. Now, sometimes you can do tax work, but there's certain things you have to do. Stiff penalties await violators 25 years in prison for securities fraud and 20 years for an executive making false sworn statements. So up until this time, the corporate executives, when they have to start putting their name on something, it pegs responsibility to them, holds them accountable. So that's a good thing. And, it shouldn't have had to come to that, but unfortunately we have people that don't take their job seriously, and the job seriously is, to what they owe to stockholders and owe to the investing public and society. they let their greed get in the way. Give you a little bit of a motivation of what maybe caused Arthur Anderson, not Arthur Anderson himself, he was dead and buried already, but or he was living as 90 or 100 years old, wasn't active in the company that he founded and bears his name, went bankrupt. They were getting Arthur Anderson, there were two companies related under the same corporate, no, I don't think they're incorporated, they're probably a partnership or LLC. Under the same umbrella, he had Arthur Anderson Accountants and Auditors that did the accounting work and auditing work. And then you had Anderson Consulting that provided management advisory services. Some common management and ownership between those two, and they're very close, they're related companies, same ownership, basically. And Anderson Consulting was advising them, Enron, how to use special purpose entities. It's called the 3% rule, beyond the level of this course. But between the two companies, Arthur Anderson Accountants and Auditors and Anderson Consulting, Enron was paying, was paying them $1 million a week. Yeah, that's right, $52 million a year. And I forget the breakdown, but it was, I think the consulting side was bringing down like 30 million or somewhere in the high 20s or low 30s, and the balance going to the auditing firm. And they had this special purpose entity was a bone of contention, and consulting advised them how to comply with the letter of the law, but violated the spirit of the law. And the auditing firm auditing side should have known that and recognized it and told them to correct it, but they let it slide, and the rest is history. A lot of people lost their whole retirement. One executive got away scot-free. Some of them ended up in jail. One guy, I think, committed suicide. Another one died. Probably, I don't know. The pressure they were on probably accelerated his health concerns. Now, there's 5 components to internal control. You can see it listed on the bullet points down on page 7.3. The control procedures, which we're going to be focusing on a little bit, the risk assessment, the information system, monitoring of controls, and the environment. Okay, there's an organization that back in the 70s came into existence called the Committee of Sponsoring Organizations, known as by its acronym COSO, C-O-S-O, Committee of Sponsoring Organizations. Some corporate executives, financial executives, CPAs, and I believe some government. There's five groups that comprise that, and they are the gurus when it comes to internal control. They've published several white papers. They have established these 5 components of internal control, and they've expanded on those to have 17 principles that back up and are built on those 5 components. And they've published several white papers. The last one I had, I think it was 50-some pages, and the executive summary was like 12 or 15 pages, which is a joke. An executive summary should never be more than 1 page, 2 at the most, because execs don't have time to do all that reading, and they just want to get the gist of it. And if they need the details, they will look at it, or they will have one of their underlings look at it. So what's a control procedure? Well, whether you know it or not, you use them all the time. If you have locks on your house or locks on your car doors, you have an internal control. If you have a password on your computer, you are using an internal control. Those specific controls are examples of limiting access. So if on a general, I gave you some specific examples. From a general standpoint, you'd want to say one of the aspects of a good system of internal control is to limit access. Only let people who have a need to access anything be the ones that are authorized and allowed to access it. Okay. Another rule of internal control is you never, ever let one person have access to both the accounting records and the assets. In other words, we're using this half of this chapter, more of it is devoted to cash. You do not let the person who writes the check and makes you don't let you divvy up the duties. It's called the separation or segregation of duties. If you let one person write the checks, make the bank deposits, and do the bank reconciliation, you're putting them in a tough position because if something's missing, and you'd have such a system where you let one person handle everything, the accounting for the cash coming in, writing the checks, the cash going out, and doing the bank reconciliation. They have too many duties that are at odds with one another, and they would be able to steal you blind and cover it up. Steal the asset cash and cover it up using the accounting records. Now, hopefully, the accounting records should be used the opposite way to help us prevent and detect errors and irregularities. Errors are innocent mistakes that we all make. I make, ask my wife, I make 100 or 1,000 a day. Irregularities are intentional by somebody that is committing fraud against the organization. That's called organizational fraud, or occupational fraud. I'm sorry, occupational fraud. Now, the risk assessment. How much do we spend on designing a system of internal control? Well, we'd have to look at the risk of what it would cost us without a good system of internal controls. Is it worth protecting? How much we're not going to spend $10,000 to protect inventory that's worth a couple $100. Okay. And again, you're building, you have locks on the door, but you don't have to worry about somebody stealing the building. It's kind of hard to steal a building unless it's a trailer, I guess. Speaking of which, years ago in my prior career, I was doing inventory of food stamp coupons in banks, and I was up in Bradford County near the New York State line. I'm looking for this bank, and you're up in the rural areas, and you're getting close to a bank area when the houses start getting close together, because that's the center of commerce and trade. And I drive through town, and it's starting to thin out, and I turn around and come back, and I miss it. The bank was a trailer. So if anybody wanted to rob that bank, all they had to do is have a 3/4-ton pickup truck and a Class 3 hitch and take the whole bank. They didn't have to break in and take the money in the vault. They could take the whole thing. So in that case, I guess you would have to worry about the building being stolen. But, one internal control there would be to take the tires off, take the wheels off, put it up on concrete block, or anchor it in with concrete block or something. When you go to the movies, you have a ticket. When I go to the hockey stadium, they have a ticket. They scan it to make sure that I have the ticket for the right game, that I'm not using, somebody gave me a ticket from last week's game. You go to anywhere, you get a receipt, any business, you buy something, whether it's McDonald's or Boscov's, whoever, when you use your credit card, you got to give them the credit card number, the expiration date, and now they've got that little code on the back. The new credit cards, the last couple of years, we have the little chip embedded in it, again, to cut down on fraud and exercise control. Just looking at your bills monthly before you pay it is an internal control. A few years ago, it was summertime. My wife was sitting on her laptop getting ready to do some bank transfers to pay the one credit card, and she says, "Oh, when did you buy truck parts in Indiana?" And I said, "I don't have a truck, so I wouldn't buy any truck parts. And if I did, I wouldn't go to Indiana and buy them." And we also had somebody was using, we had a charge on one of our credit cards for somebody using Uber or Lyft out in, I believe it was San Francisco. Could have been LA, somewhere out in California. Yeah, looked at them, called the company, and, canceled the card and straightened out. We didn't have to pay for it, but, my wife's on top of things, and she says, this is a strange purchase. We didn't buy it. Wouldn't have. So it's a control management review. She manages the payments on the credit cards, and she caught mistakes. People make mistakes. Important work should be reviewed. Okay. So the risk assessment, how much effort are we going to spend safeguarding these records, safeguarding this inventory, safeguarding the assets? The higher risk, the more elaborate system you want to have, the more you want to spend on it. Why do banks make you go through a teller, whether it's a human teller or a Mac machine? It's a control system. I mean, it's your money. They could just as well say in the bank, "Oh, you need some money? Well, go in the safe and take it. It's yours." Yeah, well, They want to keep track of how much is yours and how much you put in and how much you take out. The information system is critical. Controls must be in place within the information system to ensure that only authorized users have access to various parts of the accounting system. Hey, how do you get your grades at the end of the semester? I put them into the registrars via the um, Misericordia Zanzibar system. I have access to my classes. I can't put grades in for classes I don't teach. I'm not authorized. I don't have access to those things. I have to be careful that I don't give my password and my name. You probably figured out that to enter a system. But if somebody sitting on a computer could convince the system that they are me, one of you could make yourself your own grade, and so that's a system the Misericordia University has built in, and I have it built in with the password too. Monitoring a controls. Sometimes the environment can change, so you have to monitor them. You also want to monitor them to see how good they're working. I in my prior career in auditing, two different organizations. Some organizations didn't have a manual, didn't have any training, but the people were pretty good and knew what they were doing, and kind of had a informal system of internal control just from custom and habit. Some companies had a beautiful system, professionally designed, and it's in a nice bounded book on the shelf, collecting dust, and they never instructed the employees about how to do it, or never, once you teach the employees periodically, you got to look at them to see if they are still continuing to do that way. Over time, people get a little lackadaisical, and they stop doing certain tasks the way they're supposed to be doing. That puts the organization at risk. Okay, what about payroll? Especially in places where you have to sign in or out or punch in or out. Prior career, I worked on a place where a guy put in phony overtime claims and was paid about $15,000 more than he was entitled to. It didn't work at all. And more of an auditing case than an accounting case, but you don't let somebody put their own time in. Let their supervisor have to verify that those hours were worked. When I was a tax auditor, I was traveling all over the United States, or at least all over the 48 contiguous states, and was in 27 of them in 4.5 years. Before we'd go on out of state, my partner and I would have to submit a budget for the trip. And our supervisor, our director, would look at it and okay it. Then our controller would look at it and okay it. And we had certain parameters of what we could spend as far as transportation, hotels, meals, and all that kind of stuff. And then we'd come back, file an expense report, get reimbursed, and then they would look at it a second time. Okay. Again, a control. A budget is a control. Okay. In control environment, the tone at the top. Does management play lip service, or do they actually set an example for the employees underneath them so that they will perform as directed and instructed? I'm turning the page, and it's, again, I got to wait here. Oh, hey, there you go. 5-6 seconds, electronics. I can't believe it. Okay, we talked about some of the control procedures, locks, passwords, limited access. Back when I was studying for the CPA exam 40 years ago, the review course I took and the textbooks back then used to say that a system of internal control should sparkle, but it was spelled SPARCL, sparkle, the acronym. I remember most of those. S was for segregation, separation of duties. P escapes me right now. A was proper authorization. R was proper recording. L was limited access. C was competent people, hire competent people. Again, internal control. We're business people. We're taking accounting. If you have somebody that you have a position for a controller in your business, somebody with a business background or accounting background would be preferable to somebody who has a degree in history or music. I like history. I like music. Would I hire those people to run my accounting office? I don't think so. I could find, maybe I need them one with their talent somewhere else in the organization, but they shouldn't be in charge of keeping track of the accounting information. Get an accountant to do that. Keep training the people. Like I said, at CPAs, I had to get 80 hours of continuing ed every 2 years. Same thing when I worked for the government. Our boss, we didn't have to, but he said, hey, it's a good thing, and he got us training. There's a lot of catchphrases that are going to be coming out here. Assignment of responsibilities. You can't have accountability without responsibility. And then the other thing is somebody gets caught or something saying, not my job, man. Okay, so whose job is it? Oh, how do we know? Well, the system should be designed to say who does what pretty specifically. I want this scroll down. Separation of duty, separating operations from accounting. Okay, so look at different functions across the organization. Let the salespeople do the sales thing. Don't let them do the credit approval. Why? Well, they give every customer unlimited credit because their goal is to maximize sales. The credit manager, they are to protect the company by not giving credit beyond what a person or another business has the ability to pay. So you can see that within an organization, different departments have different agendas, different things they want done, and sometimes those are at odds between the departments. So as management overall, you got to look to see where there would be a conflict and how to best resolve it. Okay, and to resolve it in a way that would be advantageous and not injurious. Injury would not injure the company. Separating the custody of assets from the accounting, I just mentioned that. Audits, have somebody else look in on it. And again, your financial audit is part of it. Part of a financial audit, the auditors have to review your system of internal control. Management's responsible for designing and implementing and maintaining it, but we have to, as auditors, have to review it to make sure it is being done. And a good part of it is just using simple things like pre-numbered documents for receiving reports, purchase orders, so you can see things tracked. Why do you think your checks are pre-numbered? So you can identify them on the bank reconciliation. Why are the invoices you get from vendors numbered? So you can have access to it. So you can keep track of things and match them up with the receiving report and the purchase order and all that kind of good stuff. Reconciliation upon reconciliation. Electronic devices. Internal controls. I don't know if you folks have noticed it, but whenever you go anywhere now, $50 bills, and now some places are dealing with the $20 bill. They used to have a little thing they could put it under a sort of ultraviolet light or something. Now they have that pen that's like a brownish or black color. They strike it and disappears if it's a good government currency paper. If it's a counterfeit bill, that mark will not dry up and disappear on it. Back in my limited retail career, I did come across 2 counterfeit bills, and right away I could tell there was something fishy because you could tell the paper was not the same quality paper as U.S. Currency, official U.S. currency. E-commerce. All of it that's going out there, you wonder why there isn't more fraud. And the e-commerce. Look what happened to what was that? Friedman, whatever his name was, FTX with the cryptocurrency. Data analytics and accounting. Common sense. If your sales are going up, your purchases of inventory should be going up. If your sales are going up, your cash and receivables should be going up. Receivables may be increasing, and write-offs. The next chapter 8, will be about write-offs. something's wrong. If all of a sudden your receivables are, the bad debts, receivables that are going bad, not being collected, go up. Could be a problem in the credit department, could be a problem with somebody using the write-off method to hide theft. Again, the accounting system can be a useful tool to prevent theft. It can be a useful tool in propagating theft. Other controls: fireproof vaults, burglar alarms, security cameras, loss prevention specialists to train companies' employees to spot suspicious activity. My sister-in-law works in a Walmart down in Florida. She's a loss prevention specialist. Last week or a couple of weeks ago, my wife, her sister, they talk very frequently, and she said, yeah, she's walking around the store, and they have these people up by the self checkouts, and they're supposed to be watching things, and she sees this guy walking out with the big screen TV, like a 48-inch screen TV, and he rings it up. Nobody comes up in 1999. All they do is peel off a barcode for some item and stick it over the barcode on the TV, on the box of the TV, scan it, and it looks like they're making a purchase. The only thing is, yeah, they are, but a big screen TV is not $19.99. Just security camera, or just having somebody stand there is a deterrent. But they know once they do it, and the people who do that talk to each other, and they say, yeah, this is how you do it. There's a whole industry out there that will take it in, then they'll take it to another store, take it back. Oh, I got this as a gift, but I have just got one, and they'll exchange it, and they'll get the refund for the $200-300 of the real value. Or they'll take it and sell it at a flea market that weekend for $200-300. Big markup there. Fidelity bonds to reimburse the company for any losses. Yeah, and also insure your employees. When you get an insurance bonded employee, the insurance company is going to do a background check on them. I was involved in a case one time in my prior career where the bookkeeper stole once every $6 over a 2-year period. This company had about a little over $600,000 in their total revenues, and this girl took $116,000. One out of every $6. Went on for 2 years before anybody. And the only reason they knew is she wasn't paying the payroll taxes, and the IRS sent them notices. Well, they came to her. She ripped them up, threw them away. Finally, the IRS came and knocked on the door and said, how come you haven't paid your payroll tax? So we admitted your payroll withholding taxes. And then they caught her. Well, they didn't actually catch her. They knew something was wrong, and they called us in, and I got to do the job. And after I spent a summer down there recreating everything, because she crashed the computer system, and it was so rampant once I got into it, I said to myself, I can't trust anything I see here. I have to recreate everything. So it took me 3 months of the summer. Now, here's the thing. The person who was in charge down there had a background in public relations, and it was an organization that provided occupational therapy to young crippled children. And so the big expense was salaries and wages. And she was ordering things, but when you charge an expense, you got to cover the money going out that she was stealing, and she was putting it into different expenses. And if you looked at your budget, you could tell darn, absolutely there's something's wrong. And, after I sat down with the executive director, who, by the way, said, you want to see what I have? I says, no, let me go through everything, and then I'll sit down and compare with what you have. She said, well, I think it's around $40,000. And I said, oh, good, man, let's see what I can. Maybe you found some things I'll miss. Maybe I'll find some things you missed. Well, it was more like the latter. She came up with $40,000. I came up with $116,000 missing. So when I got done with my work, I started going over things with her, and she looked at some of these companies that they were allegedly buying things from. She said, we don't deal with that company. We don't deal with this. We buy that stuff from this place or that place. Well, they paid attention, they would have known right away, and they would have minimized it. Poor internal control, or there was no internal control down there. They hired this young lady to be their business office manager, and she ran everything. And she ran it into the ground. And she also ran herself. I forget if she got 1 year or 2 years in jail, courtesy of the Monroe County. District Attorney's Office. Okay, hey, page started about 3 or 4 seconds that time. Now, internal control is not foolproof. In Philadelphia, they have a problem with car theft. In fact, when I would go down to our Philadelphia office, I think they were on the 7th floor. The one guy came into work one day, looked out the window, sat down at his desk, looked out the window, and he saw his car being stolen. So his brother-in-law was a Philly police officer, called, and they had the kid. There was a high school right there, so these high schoolers would take these cars for joyrides. And you'd walk down the block there, and every car would have a club on the steering wheel. That bar, it's a little bit of a deterrent. You can't cut the bar, but the high school kids, 16, 14, 15, 16, 17, 18-year-old, and I guess down there, and some high schoolers were maybe in their early to mid-20s, they just would take the hacksaw and cut a little piece of the steering wheel out and slide the bar off. Yeah, you can drive a car if you don't have a full steering wheel. And, you have a deterrent, you have somebody that can overcome it. The thing is, where do you strike the balance between how much are you going to spend to protect something versus what the thing you're protecting is worth? So there is no foolproof system. My wife worked in information technology. They had a person there that claimed they could build a firewall that nobody could get into. She said when that person said that, their credibility went down to zero or near zero, because my wife was intelligent to know that that's impossible. If these big companies, and you hear it all the time, can get hacked, if the IRS can get hacked, everybody can get hacked. Okay. There are people out there that are professionals at it. There's people out there that do it just for the sheer joy and challenge of it. Okay. I'll give you an example there. A security guard at a retail costs $20,000 a year. On average, each guard prevents about $50,000 a year. That's good. That's money well spent. If you're spending $28,000 a year on a guard and your losses are only $2,000 or $3,000, that's money not so well spent. Maybe you can get away with just a dog at night. Okay. Cost benefit ratio. Okay. All right. Bear with me for a few seconds while this changes the page for me. Hey, I'm getting good at this stuff. Internal control dealing with cash. Well, cash receipts and cash disbursements we have to be concerned with. So when money comes in over the counter, and I want to change it, it doesn't. When I don't want it to change, it does. I just ran the cursor over the thing and it changed. Let me back up. Okay, all sales should be rung up on a cash register, documented somehow in ink. Either the register, cash registers, if people that never work retail, have two tapes in them. One that gives a receipt to the customer, another one internal that keeps track of all the sales for the day. And those two things should match, plus the money taken in and reconciled by the manager or the manager and the employee. Okay. At the end of the day, several times a day, business's risk manager deposits the cash in the bank. When I worked, we were allowed to have, we started the day or our shift with a $25 change fund, coin and currency, and we were never allowed to have more than $125 to $150 in our register. If the regional manager came in and they did a spot check and we were over that, we would be cited for it. Once we got up over $100, we'd call the manager down, had a form, they'd sign it or initial it, I'd initial it. They'd take it and put it in the safe. Then periodically during the, well, not periodically, but at least once a day, the manager would take that to the bank. So if somebody came in and did at gunpoint force us to open the safe, which was, 3 locks on it, combination lock and 2 key locks, and big heavy things that, took time, and small little hole to access with your hand. Again, the longer you could, make it more difficult for the thief to get it. They don't want to be in the store any longer than they have to. They want to be in and out quick. So you do a system where, it makes it more time consuming for them to get at it. But you also want to minimize the amount you have on hand to, if that does happen, that you will only lose a couple $100 instead of a couple $1,000. So Recording the sales quickly, taking the money to the bank, vary the times you take it, vary the route you take it. If you have a lot, have the armored car carrier come and pick it up. Yeah, it'll charge you, cost you money, but that armored car is a lot safer than than my Buick. And those people have sidearms on them and bulletproof vests, and they are trained professionals. I was in a armored car warehouse twice in my life. That's an experience. I was also in a prison, not as an inmate, but the security go around and go through all these, razor wire, and then you get into the administration building, and I had to go through. I was actually teaching for the community college down there, and go through all these locks. And then it dawned on me, you got 800 inmates coming back from supper, and you've got 3 towers. If something happens, the guards can't handle. 3-4 guys can't handle that if there's a riot broke out. Cash receipts by mail. They give you exhibits 7-1. You look there, you got a high road and a low road. The mailroom, it comes into the mailroom. The mail clerk makes a list of the checks that come in, remittance advices. You send that in with your payment, and the checks go up to the high road, to the controller, the treasurer function, to go to the bank. The remittance goes to the accounting department. The accounting department touch the checks, does not touch the cash. They only account for it. Rule number 1, don't let one party or one department handle both the asset, cash, and the accounting function. You separate them as soon as it comes into the place of business. The cash goes up to the treasurer's department, and they prepare the bank deposit ticket, take it to the bank. The advice, the list that was the mailroom clerk did, and the mailroom clerk might do this as somebody's watching them or sitting along to them. One of the things internal control can be circumvented is by collusion. Okay, but so if you have 2 or 3 people involved in the process, one watching the other and the third one watching both of them, is less likely to have collusion. So the list goes to the accounting department. The accounting department will then use that as a basis for debiting cash and whatever, crediting sales or accounts receivable. And then they have the amount posted to the cash account in the accounting system. And then look what happens. The bank receipt, the deposit of the receipt goes to the controller, and the accounting department's work goes to the controller, and they look at it and match it up. How much was sent to the bank? How much was put in the cash account in the general ledger, and vice versa. Okay, so they show you that schematically there, and then they walk you through it verbally, with words. Step 1, all incoming mail is opened by the mailroom employee, sends all the customer's check to the treasurer, and all the remittance advices to the accounting department. Treasurer has a cashier deposit the checks in the bank, and cashier receives the deposit from the bank. Accounting department, bookkeeper uses remittance advice to record the journal entries to the cash and the customer's accounts, so that'll be the receivables, crediting them. And final control compares the records, the bank deposit tickets with the amount debited to the cash account. Okay. Some companies use a lockbox system. I found my prior career, I got a guy arrested and convicted because he was stealing money with a former vendor that he was close with, buying hospital supplies for a hospital. And he was dumb enough to make up a story. He had to get the checks cut. That was the easy part. The hard part was converting those checks to his use. So he would forge the guy's name on the back of the check, and then he would co-endorse it. And when we found checks like that, we asked him about it. He said, "Oh, he's from down Philadelphia area. He wants to cash the check up here because he's on a business trip. So I'd take him to my bank and I'd co-sign it for him so they would cash it." BS. And I knew it was BS as soon as he said it. Number 1, the businessman's going on a business trip. He's going to take money. He's going to use his credit card. He's not going to use company checks to cash it for his business expenses. Those checks should go into the business account. Okay, they don't get cashed in an out-of-town bank. Very suspicious. It was only about $15,000, $20,000 involved, but the guy lost his pension, and did get a record. I don't think he did any jail time. But Lockbach, if the guy was smart, the guy that perpetrated the fraud, he would have went down to this area where this company was located when they were active. The guy had retired and opened up an account under that guy's business name or something very close to it, and had the money sent right down there to the lockbox. They would snap it for deposit only, and then all he had to do was pick up his phone, transfer it to his account or his wife's accounts, or a couple, use a couple dummy accounts to make it harder for guys like me when I'm trying to catch him. But that guy was so dumb, he deserved to get caught. Well, everybody that commits crime and fraud deserves to get caught, but they were so dumb. It made it easy for me. The only thing is I had to go through, I forget, 10 or 11,000 checks. I got real good at getting a monthly statement of checks about that big, tilting them this way and flipping them over, because I was only interested in one thing, looking at the back to see ones that had a double endorsement. Yeah, once you crack that, it was just a matter of tedious work, going through them all. But you got good at it every day, every hour I got better at it. What happened here? Please excuse me, bear with me while I went about 8 or 10 pages. Okay, checks received by mail. Okay, here's the internal controls with respect to cash payments. Make as much disbursements as you can by check as opposed to cash. Now, you can't do everything by cash, so we're going to look at what a petty cash system is and how it's done. And again, we're going to establish that. They call it the impress petty cash system sometimes. All it is, you establish a fund, say $100 you have laying in a cigar box or a tackle box or an envelope or a bank bag, and you need something. Send somebody to the store for coffee. Take $10, get the coffee, come back with a receipt, take it out of petty cash. When that petty cash gets down to $20, you add up all the receipts. And if you don't have a receipt, you have a little piece of paper, a form made up for the date, time, who did it, who authorized it, what they got, and then how much it was. Because, the paper boy is not going to give you a receipt. All right. Sometimes a pizza delivery guy is not going to give you a receipt. Or if they give you a receipt and you give the kid a $2 tip or whatever, ask him to sign that or initial it that you gave him a $2 tip out of petty cash. At any given point in time, the total of the receipts and the petty cash memos, those are what is used when you don't have a receipt to document the purchase, the disbursement, should add up to $100. So if you have $20, you're down $20, you should have $80 worth of receipts. You replenish the cash, get a check cut from the treasurer or whoever writes the checks for $80, and then start the thing all over again. Every time you replenish it, you got to take a look at what you've been spending it on, make sure it's documented. Again, setting it up, they just authorize it. Then they have a petty cash sticker there if there is no receipt, date, amount, what it was for, and what account should be debited and received by, and the initials of the fund custodian. Again, they have 2 people involved to reduce the chance of theft. The more people involved, the better. But every time you involve somebody, you should have a document showing that it's been changed and everything. Something changes hands, you pegging responsibility. Replenishing the petty cash. We just talked about that. What are we going to do now? The big thing in this chapter is the bank reconciliation. That should be coming up next. Charging account, petty cash. Come on. Hey, what are the internal controls needed with debit and credit cards? We had that problem in Luzerne County years ago. So somebody from the prison went out to a convention in Las Vegas, and they used the county credit card for things that they shouldn't have been using. That happened to me once. I had a state-issued credit card, and it was identical same company, a MasterCard, I think it was, looked like the same one I had, and I, you know, had both of them in my wallet. And I tried to buy something at Lowe's, and the one we had, it was restricted to gas stations, hotels, and restaurants. I couldn't buy anything other than that with that credit card. And I'm at Lowe's, I forget what I'm trying to buy, and the lady says, "This credit card's no good." And I looked at, oh, that's Colin. That's my company credit card, not my personal one, and got the other one out, and no problem. So yeah, you can restrict what a credit card is used for, and you should have somebody reviewing it. Years ago, when I first started at Misericordia, I had one of the reasons I got hired was to start the forensic accounting to, do the curriculum and build the 4 courses and teach them. But right off the bat, we didn't have them approved, so we taught it as a special topics for 2 semesters. And I had a young fellow who was an enterprising fellow who was running trucks up in the Marcellus gas area up there in Towanda, Bradford County, up around Towanda. And he was in class, and he says, "Hey, is there something I could do with credit cards?" And he said, I said, "Yeah, just some basic common sense." And he's got diesel trucks, and he hired some, and every driver has a credit card so they can fuel the truck during the day. And he's going over his bills, and he sees there's unleaded gas, and he doesn't have any trucks that uses unleaded gas. So he calls the employee in. It was a new hire, and new hire said, "Well, I didn't get paid yet. I just got hired. I had to put gas in my car to get here to work." And then he looked at the bill. He says, "Well, you needed the hot dog and the coffee too?" "Yeah." And I said, "Do you have a policy?" He says, "Not really. It's just, it's kind of understood that I'm giving you a credit card that's only to be used to put diesel fuel in our trucks, our company trucks." I said, "Well, you got to make it clear to the employees. You didn't tell the employee that it was limited to filling the trucks up." When I worked with the government, when we first got computers, they had a policy before they gave us laptop computers of what we could use them for and what we had to do. You can't leave them in the car overnight. And you take them to your hotel room, and, hide them, all those good things. And again, people say, "Hey, a good thing is get yourself the bag, put it on your shoulder." You're walking through an airport, these guys would come up with scissors when they cut the strap and they run off with your computer. It's amazing, the people that work outside the law. They're very creative. Okay. Again, when you're using a credit card, you want to make sure that some people, I think they have their picture on the credit card, but you can ask for ID. You can again, the big thing is using it in the gas station, pay at the pump. Now, a lot of the newer pay at the pump things, they have a little bit of a thing that the card goes in there a little bit further. Those are the good ones. I wouldn't use the other ones. And those things are usually done by rings that travel around. So it'll hit an area. When they get too hot, then they go to another area. Use some of the things I suggest with credit card. Use designated point-of-sale terminals. Never print the full 16-digit card number on either the business or the customer copy of the receipt. Again, most of the ones I see use the last 4 numbers. And the other ones are X'd out. The system knows it, but anything that's written down, because you drop that on the floor, somebody gets that and they can use it to place an internet order for you and charge it to your card. Refunds or credit debit card payments should be made by an individual other than the person reconciling the transactions. They should be trained in appropriate procedures. Storage and retention of credit debit card information should be kept to a minimum. Cardholder data should be maintained on a secure network behind a firewall and encrypted, and even that's not foolproof. And there's 2 methods, the net and the gross method, because every time my credit cards help increase sales, but there's also an increased cost with that. The credit card companies usually, they've got to make money. They're providing a service, and we'll talk about this in Chapter 8. They'll do the billing. They'll do the collecting. They take the risk of loss if the customer who owns the credit card doesn't pay. So they usually work on 4 to 6%. I think American Express is high at 6%. The Discover, MasterCard, Visa, they on the lower end around 4%. So if you have a $100 purchase, the credit card company is going to send the merchant, the business, $94, $95, $96, depending on the thing. Plus, I believe there's a swipe charge per transaction that's 50 cents, 25 or 50 cents per card. So at the end of the month, they are either going to, you can recognize the expense or you can pick up just the net amount. And they show you that there in uh, page 716. And who's responsible for internal controls and what happens if they fail? Well, you got to go back. Management is, okay? It's their system, and they're charged with protecting the assets and ensuring the accounting system's integrity, financial reporting integrity. There we go now on page 7-17. How can the bank account be used as a control device? Well, you should only have authorized people being able to write a check, sign on a check. If a lot of places, if a check is over a certain amount, say $500, then company policy is to get two signatures, two authorizations on the check, second pair of eyes, okay, for larger amounts. Okay, the bank has a signature card, and they should only honor checks that are signed. They can't do it because the volume is just too big. The deposit ticket, standard form completed by the customer, and it should show the amount of deposit, proof of the transaction. Customer receives the deposit receipt from the bank when they take it in. And the bank, of course, the bank's going to count it and reconcile it. And check. To pay cash, the depositor writes a check, which is a pre-numbered document. It tells the bank to pay a designated party a specified amount. They show you a check and a remittance advice. Okay. Most commercial checking accounts will have a stub on them. Okay, for the description, the date, and the amount, and also who's it paid to. So the one we see here in Exhibit 5 is paying to California Office Products $300, and a whole bunch of stuff there. Routing number and account number down the bottom, and there's two there. The treasurer signed it and the president signed it. So that's a good control, having two people sign the check to make it an official document, authorization. The check has two parts: check itself and the remittance advice, routing number, account number, and importantly, the check number. And we'll see where that comes into play shortly. Just hit the arrow to turn the page, and it's not turning, so I'll hit it again, and then it'll turn 2 pages. All right, the monthly bank statement. All right. Let's take a look at Exhibit 7-6, Valparaiso State Bank. There's a very good school named Valparaiso. Oh, come on. There we go. Top of the, it has the name of the bank and name of the Smart Touch Learning here, and the checking account number, the date. And across the top, right under the blue, they have the beginning balance, the total deposits, total withdrawals, service charges, ending balance. That's a summary. That's good. But we want to be interested and focused in on the details. Underneath, they have transactions. Okay, that big dark black line. And up the top, they have the deposits with the date and the amount and the type. First 3 are physical deposits that Smart Touch Learning took over to the bank. EFT is an electronic funds transfer where a collection from a customer. A customer did not send us a check. They made an electronic transfer from their bank to our bank for the $100 that they owed us. And then the last one there is interest that the bank paid us. Okay. So if you'd add those up, you don't see it there, but that would be the total deposits. Service charge. The bank has a service charge of $20. Okay. Then they have the checks. Those are the checks that have cleared the bank. Not all the checks we've written will clear the bank. There'll be some what they call outstanding checks. And that's where the check number comes into play. You can see they check 202, 201, 200. 203, 205. So obviously 204 would have been written between 203 and 205. 200, okay. And again, there might be other ones. There's other deductions. These would be EFT, electronic funds transfers, that we made. So you got to be careful with the EFT. EFTs come in for receipts from customers, and EFTs go out where we're making payments. Here we made a water bill and another deduction for NSF is the abbreviation for not sufficient funds check, meaning somebody sent us a check. Well, we think all our customers are good. We're going to debit cash and deposit that check. When it comes, our bank will take it and send it to the corresponding bank that it was written on. The corresponding bank will say, hey, this person's overdrawn. That check is no good. It bounced. So it'll come back. So we put the check in, counted it as good, but it turns out it wasn't good. So that they're going to deduct that. The bank is going to deduct it from on the statement that our balance in our account is overstated, in this case by $1,200. EFT they talk about, and again, it's what, 63 cents for a stamp anymore, plus the envelope, and then it's a lot easier. Just hit a couple keys on the computer and transfer it over. You're going to see more and more of that every year. I don't know if you folks do it. My wife does quite a bit of it that way. So now the bank reconciliation. I'm going to give us two general rules that should help clear this up. They're going to go through this item by item, reconciling item by item. But I like to do things simple. When we get information at the end of the month for the bank reconciliation, and we will have one on the next exam, I want you to ask yourself, which party is not aware of this happening? Okay. So that'll tell you what side the reconciliation has to happen on. Okay. Now, if we write a check and it doesn't clear, the bank is not aware of it. We've recorded it. We wrote the check. We know it's going to be on, we're going to have a balance per the bank and a balance per the books. The balance per the books is the company's view of things, what they know of. The balance for the bank is the bank's side of the statement. So if we wrote a check and it didn't clear, the bank has no knowledge of it. So we're going to have to do the adjustment on the bank side. And what does writing a check do? It decreases the amount. All right. There's going to be 4 possibilities here. When we set this up, the format, and I'll send a format out for you guys. You're going to have the bank, balance per bank on one side, balance per books on the other. Balance per books is the company side. And then you go up the top, you're going to have add, and then a little bit down below, you're going to have subtract and subtract, or less and less. I forget if I have subtract or less. Okay. And then you just got to figure what side, when you get the information, analyze it and figure which side. Is the bank aware of it? Well, if the bank's aware of it and we're not aware of it, the adjustment has to occur on our side. And then figure out, would that adjustment increase or decrease? And you can't go wrong. Okay? And we'll walk through these here. So they give you a T account there for the cash account for April for Smart Touch Learning. They got the beginning balance, and they have debits, which would be increases, and they have credits, which would be decreases, and then the ending balance. Well, let's flip back. Smart Touch Learning is saying they have $20,850 in their cash account. Let's see what the bank statement says. I'm trying to turn pages here. Please bear with me. Okay, let's go back here. I guess I got to go back one more page. $20,850 is what our cash account says, and the bank balance says we have $12,720. Yeah, difference of opinion there. No different facts. There are transactions we are aware of that the bank isn't, and there's transactions that the bank made on our behalf that we're not aware of until we get the bank statement. And so that's what we got to do. Now let me get back to that T account, 2 pages, 2 clicks. All right. So they show us the T account with the balance for Smart Touch Learning's cash. And it says a bank statement show. Oh, there it is there. The bank ending statement, 12,720. So there's a little over $8,000, $8,130. Now, what they say here are timing differences. The books, the balance for the cash in the general ledger, and the bank statement usually show different cash balances. The differences arise because of a time lag in recording transactions, called timing differences. 3 examples are this. When the business writes a check, it immediately deducts the amount in its checkbook and the cash account. The bank, however, does not subtract that check from the company's account until the bank pays the check a few days later. When a company deposits cash in its account, it immediately adds the cash receipt to the checkbook and the cash account. However, the bank may take a day or two for the deposits to be recorded. I know my bank, if you go in after 2 o'clock, the deposit will be shown as during the next day's business. If you do a deposit a weekend or a holiday in the night depository, the bank won't have that until a day, if you do it on a Friday or Saturday and Monday is the 4th of July, they're not going to get to it till Tuesday when you go in when the bank is open. Give them the key for the bank bag and take it out. So that's called a deposit in transit. Okay. And finally, we have the EFTs, cash payments, and EFT cash receipts are often recorded by the bank before the company is aware of them. Okay. So we got to do preparing the bank side of the bank reconciliation. They take it side by side. I like to take it transaction by transaction because then you got to put it in one of those 4 spots. Bank side, add, company side, book side, add, bank subtract, company subtract. Just ask yourself, well, let's walk through this. A deposit in transit. Well, who's going to be aware of that? The company is going to be aware of it because they made it. They took it to the bank and put it in the corner of the bank building with that night depository. The bank's not aware of it. It's in the bank, but the bank is locked, and it may be locked for a Saturday, Sunday, and a Monday holiday. So it'll be there 3 days. The company's aware of it. The bank's not aware of it. And if that 3 days is the end of the month, happens in there sometime, it's not going to be on that bank statement. So we're going to have to, let's see, who's not aware of it? The bank's not aware of it. So we're going to put it on the bank side of the reconciliation. And now what does a deposit do? Does it increase or decrease the balance? Well, the deposit would increase the balance. So it would be an adjustment on the bank side and it would be an addition. Outstanding checks. The company writes the checks and the company's aware of it. So which party's not aware of it? The bank's not aware of it. So it's going to be an adjustment on the bank side, and it's going to be a subtraction because when you write a check, your balance goes down. Pure, simple logic. Bank errors. Yes, banks make errors. In fact, they made one. Well, I had, I'll talk about my one mortgage. New York State Bank really screwed up the process royally. But I was paying attention. And, one time, right after I got married, I put a $150 deposit into my savings account. And I'm walking, it was up the mall. My wife worked at the mall at the time. And I'm walking out of the bank. I'm walking down the hall. And I take my passbook out and I look. And the clerk put $15,000 in my account. For a split second, you got the good angel and the devil on your shoulder. I'm saying I should go to another branch and close this account, and I can make $14,850. And I'm saying, yeah, but would it be worth the 10 years I do in prison when they catch me, not if they catch me? No, I didn't think for a tenth of a second. I turned around and I went back and I said, I think you made a mistake here. And she, oh my God, thank you. She said, I'd be here all night trying to find out where I'm wrong. Yeah, it's a machine thing. I don't know if the key stuck or if she hit it a couple times or what. It's like I have the trouble with turning the pages in this electronic book. It's not responsive. So, yeah, they make an error. Well, we're aware of it. They're not aware of it. So we're going to have to make the adjustment on their side, and it's going to be an increase or a decrease. Okay. Electronic funds transfers. Again, be careful with these. Figure out whether it's a payment or a receipt. And again, it's going to be on the bank statement. It's not going to be, we're not going to know it until we get the bank statement. So we're not aware of it. So the adjustment is going to happen on the company side, on the book side. Now, there are payments coming in from customers. Those would be additions to our balance. If there's payments being made, for, let's say, the municipal water company, we authorize them to do a monthly automatic withdrawal from our checking account based on the meter reading. We don't know what it's going to be. It's going to be on the bank statement. So, we'll have to, it's on the bank. The bank's aware of it. They made the transfer on our behalf. It was a payment, so it's going to be an adjustment on our side, on the book side, and it's going to be a reduction. Service charge. The bank may do certain things for us, and they're going to charge us. They're going to get us checks. They're going to maybe do notary service for us or collection or something. We're not aware of it until we get the bank statement. So we're going to have to do the adjustment because we're not aware of it until we get the bank statement. And usually these will be a subtraction. The one thing that's going to be an addition is when the account is an interest-bearing account, and we know it's going to bear interest, and we know the interest, but we don't know the amounts that the bank used to compute that interest because it all is due to timing, and it'll be on the bank statement. So the bank is aware of it because they paid the interest. We're not aware of it until we get the bank statement. Well, the interest is going to be an increase, an addition to our balance. We talked about the NSF, not sufficient funds check. That is money from a payment from a customer that we counted as good. It turned out the check was not good. It was dishonored by the bank. It's going to come back in the bank statement. We're not aware of it until it comes back with the bank statement. So the adjustment will be on our side, on the book side, because we counted it as good when it in fact is not good. It bounced. And we're going to have, if we counted something as good, we put it in a deposit and it's no good, then we have to take it out of the deposit. So the adjustment will be for an NSF check will always be on our side, the book side, and it will be a reduction. It will be a subtraction. Book errors. Sometimes we have a error in bookkeeping. Well, we'll find that out when we get the bank statement, and we'll say, hey, we recorded check 540 for $104. And it should have been for $140 or at 104, transposition error. So we'd have to do an adjustment there. Okay. Again, just take a deep breath, slow down, and ask yourself, which party is not aware of this, and what's the effect, increase or decrease? And that's simple. Now, the bank, they show you the bank reconciliation there for and the items, so you can look at that in Figure 7.7, reconciling items. On the bank side, we have the deposit in transit. Yeah, the company made the deposit. The bank's not aware of it, so it's going to be an addition. It's going to be an adjustment on the bank side, and it's going to be an increase. So it's added deposit in transit. And then we have the outstanding checks. Checks we've written. Check number 204 for $2,000. We're aware of it. The company's aware of it. The book side is aware of it. It's already subtracted. The bank's not aware of it until it clears the bank. It didn't clear the bank yet. So it's going to be a reduction on the bank side. Over on the book side, what do we have here? EFT receipt from a customer. We're not aware of it until we get the bank statement, and the receipt is going to increase our balance. The interest earned is going to increase our balance. And then the next item is the bank service charge is going to decrease it. Again, all these things on the right side, the book side, we're not aware of them until we get the bank statement. The EFT payment of the water bill will be a subtraction, just as if we have written a check. And the NSF we counted as good, we have to back out because it bounced. Add those two up, add the adjustments to the beginning balances, and we should get the same thing, and that's called the adjusted balance. Adjusted bank balance, adjusted book balance. Look what they say there. The bank balance always adds deposit in transit, subtracts out outstanding checks, or subtract corrections of bank errors. Book balances always add bank collections, interest revenue, and EFT receipts. Always subtract service charges, NSF checks, and EFT payments, and add or subtract corrections of book errors. The correction of the errors are the ones you're going to have to stop and think, how's it affected it? Did you add too much originally or not enough? And then you'll have to do the appropriate thing to get the right amount. After this, they go item by item. Deposits in transit, outstanding check. Yeah, I'll have to scroll down. Oh, come on. Okay, these items affect the bank side, have been identified and adjusted. Book side of the reconciliation, you have the EFT transfers, both additions and subtractions, interest revenue, service charges, check charges, and NSF checks. Okay, those are your possibilities. We'll do some of these in these solutions, and then if we have adjustments on because of the bank reconciliation, we have to do adjustments in the journal and post them to the account. So you can see those for all those reconciling items there. The cash receivable is $100. They record the account receivable collected by the bank. That's the EFT collection. Then the interest revenue, cash is going up. Interest revenue, revenue account is being credited to increase it. The bank expense, that's a service charge. So bank expense goes up, cash goes down. Utilities expense, that's the EFT payment we made, our water bill. So cash is decreased and the expense, utilities expense is increased. And to record the NSF check, when the check came in, we would have debited cash and credited accounts receivable for that customer. So we have to reverse that entry, put the receivable back on the books because they still owe us the money. Because when they pay with the bad check, it's not paying us, doesn't wipe out their debt to us. And then reduce the cash by the same amount. We counted the check was good, turned out it wasn't. Oh, this thing is driving me crazy. Oh, come on. It just went bonkers on me. I don't know how many pages it would I have now. I'm in the review. Okay. Those are the journal entries we just went over. Trying to get over to page 25 from page 24. How can the cash ratio be used to evaluate business performance? Cash ratio is cash and cash equivalents divided by total current liabilities. Again, to me, that looks like it's a liquidity ratio. But yeah, company ability to meet its short-term obligations. How much cash do we have to pay our current liabilities? Very, very strict. The strictest, we have the current ratio, we have the quick and acid test ratio, now we have the cash ratio. All measures of liquidity in ascending order of strictness. Cash and cash equivalents. What are cash equivalents? Traveler's checks, negotiable order withdrawals, bankers' acceptances, a whole bunch of things. Anything that could be cash within, say, 30 or 90 days would be considered a cash equivalent. Cash equivalents are highly liquid investments that can be converted into cash within 3 months, 90 days or less. Government security, money market accounts, negotiable order withdrawals, everything, bankers' acceptances, traveler's checks, all those things. So then they show you the computation of the cash ratio for Kohl's there. I think that does it for chapter 7. Yep, that takes you into the review. Okay, so that'll be it until Wednesday or Thursday when I send out the solutions to the end of chapter assignments as per the syllabus.